Uh, Good morning, everyone. Today, so for this slot, we're going to be having a class for Rsk4803, which is risk financing. And my name is Renos Muusha, and I'll be taking you for Rsk4803. Then if you have any queries or you want to send an email regarding any query that you have as well, my email address is 27287956 at tuks.co.za. And then my cell phone number is 084-855-8155. So these are the numbers that you can either contact me if it's going to be via a call or if it's going to be via WhatsApp as well, right? So when you look at RSK403, we are looking at risk financing. And for this particular module, there are 6 topics that we're going to be covering for this particular module. So you see that for this particular module, there are 6 topics that we need to cover. And the first topic that we're covering for this particular module looks at just basically a general overview of risk management. So you see that it's going to be general overview of risk management. And for that particular topic, well, it's going to be covering 3 study units. The first one, which looks at case studies, covering the lessons that are not learned when it comes to risk management as well, and what are they, and when we say risk management would have what failed for a particular organization as well. Then study unit 2, we look at enterprise risk management, where we are basically saying that historically, when it comes to risk management was just operating in silo as a separate department, not necessarily being interconnected with other departments of the organization as well. But we know that risk is basically prevalent in any activity that the organization pursues. Because remember, for the organization, for it to be able to generate a return, they need to be able to generate what? To take risk as well. Because if they are not going to be taking risk, the investor might as well just invest their money in what? In a risk-free instrument. So which means the enterprise is going to be taking risks, which basically means that the risk management department will need to be working in conjunction with the other departments, like, for example, the sales department, the marketing department, the manufacturing department, the finance department as well. Then the next one, we look at study unit 3, which looks at the capital in enterprises. Now, when it comes to the capital in enterprises, we're looking at the financing of the organization. Now, when you look at the financing of the organization, we're basically saying that traditionally, when we looked at the financing of the organization, we didn't look at the risk financing component, because the only financing that we looked at, for example, when you look at the accounting equation, we said your assets is equals to equity plus liabilities, right? But we didn't look at the other element where we look at risk management perspective to say there's also a risk capital that is needed for a particular organization as well, so that in case a risk event happens, it does not hinder the going concern of the what? Of the organization. So that's basically what we're going to be looking at in study unit 3. Please take note. Today, I'm just going to give you a brief, just brush through so that you know exactly what study units we're going to be covering. But please note that there's a video that we did last year which looked at in detail analysis of every study unit that we're going to be covering, from study unit 1 to study unit 2022. There's a video that I did, and I'm sure most of you have already sent you the video for that via WhatsApp, for you to be able to go through that YouTube video as well. It's a very, very important video because it gives you a guideline on exactly how to go about when it comes to what to expect when it comes to the study units that are going to be covering, what to expect when it comes to our calendar, what to expect as well when it comes to the assignments, and also what to expect when it comes to revision. Then over and above that, in that particular video as well, I also gave a guideline on exactly how to maneuver our website. Because remember, Once you create a user account on our website and we link the modules that you want to have access to, you will be able to access the soft copies of either the articles, if it's an Rsk4803, or the soft copies of the textbooks that are needed for Rsk4804 and Rsk4805. So you don't necessarily need to buy those textbooks because we already have the soft copies of the textbooks and the articles. And over and above that as well, you will see that these textbooks and articles, they are already highlighted when it comes to the important things based on the lesson outcomes that is expected for each particular unit. And they also have a bit of notes on them if there's a need for further explanation as well. So please take note that the soft copies of the textbooks, you are able to access that. And remember, the video that I gave you as the link to the YouTube, please go through that particular video because it gives you all the information in detail. And it gives you a holistic understanding of exactly what you should expect when it comes to RSK.03 as well. So please take note as well that we are an independent private tutorial service provider, which basically means that we are independent of UNISA, which basically means that what we do here is that we prepare you so that you are able to go and pass the exam when it comes to the GenFeb exams in 2025. So where our part comes in is that we are an independent service provider, which ensures that we prepare you to ensure that you're able to pass your exam as well. Now, when it comes to how we offer the module and all those, please go over that particular video because it's very, very important because it gives you an intricate guideline of exactly how to maneuver our website, how to get the material, what to expect during the year as well. But remember, on our side, we are going to assist you to go through the study units. We are going to assist you with assignments, and also we are going to assist you when it comes to revision as well. So basically, we're going to be assisting you with everything that you need between now until you write your exams in the GenFeb 2025 period. So the information on exactly how to maneuver our website, where to get information, please go to that particular video. It's a very, very important video because it's an orientation video which gives you a guideline and a better understanding of exactly where everything fits in when it comes to RSK4803. So are there any questions before I continue when it comes to showing you exactly which topics we're going to be covering? Any questions? All right, so that is topic number one. Topic two, we are going to be looking at, when it comes to topic two, we are going to be looking at study unit 4 to 7. So we're going to be looking at study unit 4 to 7. So study unit 4 looks at the philosophical context when it comes to risk financing. This particular topic, expect a lot of theory questions to be coming from this topic as well. And as we have seen, when it comes to the GenFeb 2024 paper, for the first time, the lecturer has brought in multiple choice questions, which is basically those short questions as well. And we were suspecting that they might bring those multiple choice questions because if you look at the way the lecturer brought in the assignments as well in the previous year, I think there was about 2 assignments where it was those short questions, which is basically multiple choice questions where you choose an answer. They give you either a case study or they give you information and then they ask you to answer based on the material that you would have covered in the study units as well. So please note that how the questions have been asked historically as well, the lecturer has now started bringing multiple choice questions on when it comes to what you've covered as well. So which means study unit 4, we expect a lot of theory to be covered under that when it comes to risk decision making. And when it comes to decision making, we'll expect a lot of what theory questions to be asked there as well when you are expecting theory questions, those multiple choice questions in the exam. Then study unit 5 looks at moral hazard and adverse selection. And we're going to look at it in detail to say exactly, so what is the situation which we consider to be moral hazard, and what is the situation which we consider to be adverse selection, especially when it comes to insurance as well. And we're going to look at that in detail. Then study unit 6, we look at utility theory, where you look at maximizing the satisfaction that an individual or an investor has from their investment as well. And the interesting thing about this concept of utility theory, they also link an individual's level of utility when it comes to insurance. And this is basically how insurance companies as well decide to say, so how much do we charge a particular individual when it comes to the insurance the premium? To say, so how do we end up saying that this is the premium that was supposed to be charging a particular individual, and how do we ensure that this particular individual, whatever we're charging, they're happy with the utility levels are high when it comes to the insurance premium that they're going to be charged, that we're going to be charging as well. Because remember, the individual is always going to be faced with the situation to say, when it comes to risk situation, should we retain risk or should we transfer the risk? And one way of transferring the risk is through insurance. And another way is through retaining the risk, where they say, if the risk event does happen, I'm committing to absorb that loss amount on my account as well. So which means an individual is always going to be making decisions as well. And one way that individuals make decisions as well is through understanding the levels of utilities that individuals get as well. Then on study unit 7, we look at decision-making techniques. And this is mainly looking at seeing exactly how does risk financing also links to capital budgeting. And one of the more important capital budgeting techniques that are going to be looking at, the most common one is where we look at the net present value as well. And we're going to be looking at that in detail. Then please note that when it comes to study unit 7, they also ask us to look at Rsk4803, which is rational decision making. Go through it. There is a video that we also make available to you guys to go through when it comes to study unit 7. But please don't spend too much time on that as well, because from a practical perspective, when it comes to saying that you have now managed to get your postgrad diploma in risk management, yes, you need it. But when it comes to the preparation for the exam, the lecturer hasn't really gone that in much detail, because it's a lot of statistical concepts that they go in detail on as well. But from those statistical concepts, there is concepts that are going to be picking and choosing that we know that they're going to be relevant in the study units that are going to be looking at as well later on. So those are the ones that are going to be picking and choosing, but we'll discuss that later on when we get to those study units as well. Then topic 3 looks at the risk financing concept. And one of the very common risk financing concepts that the lecturer is always asked in so many exams is the concept where you look at the cost of risk. And the reason why the lecturer is interested in the cost of risk is mainly because when it comes to the concept of cost of risk, they can either ask you concept of the cost of risk as a theory question, or they can bring it as a calculation type of question as well. So there are so many different ways that the lecturer can be able to bring this particular concept in the exam. So please take note that it's one of those highly examinable concepts as well. Then we look at study unit 9, which looks at risk appetite and optimization under budget constraints. And here we are looking at efficiency. And at the same time, we're also looking at that concept where we said, when you look at financial management, we say the goal of the firm is to maximize shareholders' wealth. Now, in order to maximize shareholders' wealth, what do we see when it comes to the relationship between risk and return? We said the investor wants to make sure that they maximize their return for a given level of risk. And at the same time, they want to minimize their risk for a given level of return as well. So which means, and because of that, we are going to be looking at study unit 9 to say, so how do we now analyze this relationship between risk and return? And remember, we also now link it as well to the cost and what, and remember, initially when it comes to financial management, we looked at it from a perspective of what? Cost and return. Now we have to link it with risk as well from a risk management perspective. So which means when it comes to an investor, their goal is to maximize the benefits, which is the return, and also to minimize the costs, which is basically the expenses. And at the same time, they also need to minimize what? Their risk exposure as well for the benefit that they're getting. Then study unit 10 basically looks an overview of what we have covered so far, and also try to link it to the next study units that are going to be looking at, which is study unit 11. Now, remember we said that when it comes to risk, one can either retain risk or they can transfer risk as well. So which means study unit 11, we now look to say, if they consider retaining risk, so what options do they have? And how do they now, an individual assess their capacity and ability to be able to retain that risk? So there are so many things that needs to be considered for an organization to say, you know what, remember we said, when it comes to risk, two things can happen. An individual can choose when they have a risk exposure. An individual has two options. It's either they retain that particular risk or they can transfer that particular risk. So study unit 11, we are basically looking to say, if they decide to go the risk retention route, what are they going to be considering? So that's basically what we look at when we look at study unit what? 11. Then when you look at study unit 12, 13, and 14, these are what we call alternative risk transfer. So when it comes to alternative risk transfer, we're basically saying when it comes to alternative risk transfer, we are saying if another way that an individual, when it comes to their risk exposure, they can either retain the risk or they transfer the risk, isn't it? So the risk transfer, we look at it in study unit 15. Now, they can also choose to have a hybrid between risk retention and risk transfer, where there's a component of risk retention, and then there's also a component of what? Risk transfer. So that's what we're going to be looking at when you look at study unit 12, study unit 13, and study unit 14. We're now looking at that component where an investor or an individual or an enterprise can now say, we don't want to fully retain the risk and we don't want to fully transfer the risk. So what can we do? We can now look at alternative ways that you can transfer the risk, where these alternative ways, we are partly retaining the risk and we're also partly transferring the risk as well. So that's what we're going to be looking at study unit 12, 13, and 14. Then study unit 15. So study unit 12, 11, 12, 13, and 14, we're basically looking at risk retention. Then when it comes to topic 5, topic 5, we are going to be looking at, that's when we are going to be looking at risk transfer through insurance. So the risk transfer that we're talking about in this case is basically we're saying when you're purely transferring the risk, this is the risk transfer where you go the insurance route. So that's what we're going to be looking at, study unit 15. Now, please note, study unit 16, 17, 18, 19. You can go over them, but historically, the lecturer has not really gone in detail when it comes to trying to understand now, apart from understanding insurance overally, how do we now go in detail in understanding property insurance, motor insurance, liability insurance, and also group personal accident stated benefits as well. Historically, the lecturer has never really gone that much. It has never gone in detail or even touched on those two particular topics. So historically, we don't go through study unit 16, 17, 18, and 19. But study unit 15 is where the lecturer has placed a lot of emphasis on, because you now need to know exactly overally if you go the risk transfer route through the commercial insurance route, how do you now go that particular route, and do you expect? And basically, so when it comes to the commercial insurance as well, what are the different components and aspects that you need to take into account when you go into the commercial insurance route as well? Then, after this, you'll see that Start Unit 20 looks at business interruption insurance. Now, when it comes to business interruption insurance, we're basically saying if one goes the risk transfer route and they go the insurance route. Now, this is also highlighted in Start Unit 8 when you look at cost of risk as well, where we're basically saying even if you're going to be comprehensively insured, there are certain elements that you're not going to be able to be insured for. Like, for example, if you go the commercial insurance route, let's say, for example, you insure your building, right? And you go the commercial insurance route. We know that as an organization, if the building is burnt down, the insurer is going to say, yes, the building is worth 2 million, for example. So we are going to make sure that we indemnify you for the 2 million that you've lost. But now, what happens between the period of the time that the loss is incurred until now the building is now fully repaired? What is going to happen? Remember, the assessor has to come in, do the assessments, ascertain exactly how much the damage and how much the insurance is going to be liable for. They do go back, and then there are so many steps that are going to be followed to ensure that before you are fully indemnified, and then you finish repairing or refurbishing the place as well. So which means an organization might end up losing maybe 1 month or 2 months or 3 months or whatever period of time, depending on the amount of damage on the building as well. So now, what does that mean? It basically means that the organization, during, for example, those 3 months, the organization is going to lose out on sales revenue. The employees are going to be very finicky because they are not sure whether their company is going to be able to recover from this particular situation. So which basically means that this is where business interruption insurance comes in, because the business interruption insurance is now coming in to say, yes, you have been commercially insured for a loss in case a fire happens. Yes, but you're covered for the building. But now what happens? What do we do to ensure that you're also covered because of what loss of this revenue as well? Because remember, this revenue is also what you use to meet your operating costs. So which means this is where business interruption comes in, to ensure that the organization is also going to be indemnified for the loss of revenue, because remember, the revenue is what the organization uses to cover their costs as well. So this is where business interruption insurance comes in, and we're going to be covering that inside Unit 20, and it's one of those highly examinable concepts as well. Start Unit 21 looks at underwriting information technology risk, and historically, the lecturer has never really asked questions when it comes to this, either in assignments or in past papers as well. So we have never really covered these particular topics. And Start Unit 22, we have never really covered this. We don't see negotiating insurance cover. It's not really part of the things that we cover as well when it comes to the start units. Then the last start unit looks at insurance-linked security and alternative risk transfer. So that's the last topic, which is topic 6. Now, when it comes to topic 6, we look at insurance-linked securities. Now, they are also going further to say, historically, in case of a loss event, especially catastrophic losses, how do we ensure that the organization or the insurance companies are able to meet their obligations, which is basically the contingent liabilities, which is basically the insurance claims? Because we know insurance companies, they are also companies themselves, which are basically committing to say, in case you as our client, you suffer a loss, we are committing to cover you for that particular loss. So how does the insurance company now ensure that they have the money available to cover for those particular losses as well? So historically, insurance was working on its own where the insurer now would depend on the money that they've generated internally from the profits and so forth. And where they know that their risk, they don't have the capacity to meet that particular potential liability when it falls due. What do? They go the reinsurance route as well, right? Where they go to a reinsurer, where they now have a contract to say with the reinsurer to say, we have this particular client, in case of a loss event, how do we ensure that now we also split when it comes to what? The risk exposures as well. But now, when it comes to the capital that the insurance companies are able to raise, it's not enough compared to potential liabilities that might fall due as well. We have seen that quite a lot, especially when you look at what has happened when it comes to the floods, especially the KZN area, and also when it comes to the looting that happened around the country as well. So those are usually deemed to be catastrophic events. So how do the insurance companies now ensure that they're able to what? Meet the claims, especially when it comes to catastrophic events? Because remember, generally, the internal funds available for the insurance company, especially even if they have their own investments as well, it might not be enough internally. So what do? This is where they issue what are called insurance-linked securities. So these securities is where the insurance company create their own insurance products and then sells them to the capital markets as products. Now, as they sell them to the capital market as products, they now are able to now have to say, in case of a loss event, we can now be able to get that money from the investors. But if the loss event doesn't happen, the investors also gain from the what? From the premiums that are also paid to them as well. So which means in this one typical insurance-linked security that is common is what? Catastrophic bonds, or in short, tech bonds. And we're going to look at that in detail, which is going to be the topic 6, which is the last study unit as well. So these are the different study units that are going to be looking at for Rsk4803. But please take note, when it comes to going through them in detail and all the intricacies as well, I have already covered them in the video that I've sent you as a link to the YouTube as well. Please ensure that you go through that particular video. So today, we are going to be looking at study unit 1.5. So we're going to be looking at study unit 1.5. And after that, we also look at study unit 1.6. So we're going to be looking at study unit 1.5. Then after that, we look at study unit 1.6. And I'm going to explain why I'm leaving study unit 1.1, 1.2, 1.3, and 1.4 as well. Are there any questions so far? Any questions? Are there any questions? Right. So just to go over the overview that the lecturer put in as a summary when it comes to risk management as well, I'll just go through this particular overview that the lecturer has shared when it comes to risk management. And looking at this particular overview, the lecturer states that yes, you are able to share the link with other students as well, because this introductory class is a free class as well, so that you see exactly how we offer our classes as well. So, are there any questions before we continue? Please take note. For our classes, even if anything, there's something that you don't understand as we're going through this particular material, don't hesitate to interrupt me so that I am able to explain in detail as well. So if there's a question that you have as we go, of something that you don't understand, please don't hesitate to point it out as we go through the particular study units as well. Because remember, our classes are online. It's very difficult for me to pick out people's faces to say, because if it was a one-on-one, if it was a face-to-face class, where there's something that you don't understand, I can easily see that there's questions here. I need to explain it further. But since our classes are going to be online, I would need you to, if there's something that you feel that you need further explanation on, or there's a question that you have as well, don't hesitate to interrupt so that you are able to ask that particular question as well. Don't hesitate to ask the questions. So, looking at study unit 1. Remember, study unit 1 is coming from topic 1, where we look at lessons not learned. And looking at study unit 1, the lecturer states that we will begin this module by trying to understand why apparently well-managed enterprises ran into serious financial problems. While some of them were able to recover, others were not that fortunate. Although we refer to newspaper articles about state-owned enterprises in South Africa, but as these are still disasters in the making, we cannot include the reports on the outcome of investigations. There are parallels between the underlying cause of the demise of private state enterprises and SOEs. However, the action or reaction to corporate failures usually is brutal and swift. Private enterprises have basically two choices when they experience a significant financial loss: bankruptcy or obtain funding from investors to continue business. In contrast, the losses of SOEs in South Africa are funded by the National Treasury. So in effect, funding incompetent, loss-making SOEs is stealing from the poorest of the poor, as funds that could have been utilized for the upliftment of communities, improved health services or education, are now used to bail out inefficient entities. So the following study unit introduces the concept of enterprise risk management. So the other modules in this qualification covered the risk types such as operational, credit, and market risk. But as this module is focused on the financing of the enterprise risk, it is essential to have a deeper understanding of how the enterprise is governed, capitalized, and financed pre-loss or post-loss events. And remember, when it comes to the financing, whether it's going to be pre-loss or post-loss as well, we're going to be looking at it as well when we look at study unit 3. Also, when you look at study unit 12 as well, we're going to be looking at it in detail. Then the lecturer also goes on to say, the risk appetite of the enterprise is also important, as it will eventually drive the outcomes of decisions. So the last study unit in this topic covers the concept of capital, risk capital, and capital budgeting. The underlying principle is that the capital is not free and good and in unlimited supply. So it is therefore important for the enterprise to have a good understanding of its cost of capital to determine which projects are acceptable or reject. And we're going to look at that in detail when we look at study unit 3 as well. We're going to look at it in detail when you look at study unit 3, which is also linked to study unit 9. Then they also say, again, the risk appetite and a very good understanding of the risks of the enterprise are critical in the process of the enterprise needs to optimize spending, that is, getting the most bang out of their buck as well. And when it comes to the concept of risk appetite, we're going to look at it in detail in study unit 9, but we are also introduced to the concept of risk as well, appetite in study unit 1.5. Because remember, we're going to look at it, when we look at it study unit 1.5, we're going to say, this is where we now look at what is the positioning of a risk manager within an organization, and how do they link in when it comes to the organization, what organogram as well. So how do they link in when it comes to the CEO? How do they link in when it comes to the board of directors? And how do they link in when it comes to the different departments as well? And we're going to look at that in more detail in study unit 1.5. So when it comes to study unit 1, remember we said we're looking at lessons not learned, and looking at this particular study unit 1.1. So you see that on study unit 1.1, they give us in study unit 1.1, study unit 1, basically, we're looking at examples of crisis experienced by organizations. And we are looking at different organizations. What I would advise you to do on your own, please go through unit 1.1, the articles for unit 1.1. Remember, once you create a user account on our website and you go to that particular video that I've sent you the link to, you will be able to download, to access and download these particular articles as well. So study unit 1.1 basically looks at the case study of ESCOM. So they look at the case study of ESCOM. Please go through it. But please note that when it comes to the exam, the reason why I'm not going to be spending time going through unit 1.1 is mainly because from a practical perspective or an application perspective in the real world, yes, you need to know when it comes to ESCOM, when can we say risk management is failed, or would we say risk management is failed at all? And you'll be able to understand that better when you look at the articles that are given for unit 1.1. But when you look at these particular articles, some of these articles are like 100 pages or even 50 pages as well. My advice is don't spend too much of your time going through that particular article as well. Brush through it so that you have a rough understanding of that particular article, but don't try to go into too much detail, because typically this is not how the lecturer asks questions in the exam. When it comes to questions in the exam, if it's going to be based on a particular case study, the lecturer gives you that particular case study. Then based on that particular case study, that's when you answer questions to apply the case study from a risk management perspective. So there's no way the lecturer is going to ask you about ESCOM without giving you a case study so that you know exactly what in particular are they going to be asking you as well. So when it comes to the exam, don't spend too much time looking at the case study for ESCOM. Go through it, have an understanding of that particular case study, because you need to understand what happened in ESCOM so that you know, understand exactly, so what is risk management? Was there a risk management failure? And how would you be able to prevent these possible risk management failures in the future as well as a risk manager? But please note that when it comes to preparation for the exam, we are not going to be spending too much time on it, because typically that's not how the questions are brought in the exam. Are we on the same page when it comes to studying to 1.1? Any questions? Unit 1.2, they also give us another case study of risk management failure. And this is where we look at the case study of Barings Bank, where we look at the individual by the name of Nick Leeson. And on this particular case study, they also give us highlight, the case study basically highlights scenarios where you see that there was a lot of risk management failures when it comes to this bank, which was this English bank, which is Barings Bank. And it was a very old bank with a lot of traditional roots. But in the pursuit of profits, the board ended up foregoing those risk management procedures, and there was a lot of risk management failures as well in the pursuit of what? Pursuit of what? Of profits, which basically means that this is where you find that an individual by the name of Nicholas and basically took advantage of the loopholes that were within the particular system as well. So please go to that particular case study, but please don't spend too much time. Know how it applies from a risk management perspective, but don't go into too much detail when it comes to this particular case study, because remember, typically, this is not how the questions are brought in when it comes to the exam. The lecturer does not bring you questions where they are expecting to say, we are on when it comes to this particular case study, what was this and what was learned and what was they, if they are going to be asking you questions regarding a case study, they have to give you that case study in the exam. Then based on the information given on the case study, then you answer the question. And remember, how you answer the question is where you now apply things that you've learned from unit 1.5 going onwards. So because of that, I'm not going to be spending too much time. But on your own time, please go through study unit 1.2. The case study for study unit 1.2 as well is a very interesting case study as well when it comes to risk management failures. What are they and how do you identify such risk management failures as well? Unit 1.3 looks at HIH, where you look at HIH, which is basically the Australian insurance group as well. And this insurer, there was a lot of risk management. Remember, if you look at all these case studies that we look at, I would say with an exception of ESCOM, most of these case studies that you look at, especially when you look at HIH, Bellings Bank, and the other one that are going to be looking at for 1.4 as well. So you'll see that most not 1.4, 1.2 and 1.3 as well. You see that the main reason why there was a lot of risk management failures is mainly because management is always going to be caught between pursuit of profits or being conservative as well. So which means in their pursuit of profit, management are always faced with the dilemma where they end up foregoing the risk management procedures as well. So you also see that quite a lot when it comes to 1.3. And especially when you look at case study 1.2 and 1.3, you will see that there's always that lingering thing where they are trying there's always in pursuit of profit, they are trying to forego processes. And at the same time, there's even elements of what? Fraud in between as well. So you will see that quite a lot when you look at unit 1.2 and 1.3, and also another issue being the issue of accountability as well. But you're going to be looking at it when you go through 1.3 and 1.2. But please take note that even when it comes to unit 1.3 as well, typically these case studies, they are there. The lecturer put in these case studies so that you're able to understand exactly. So when would you say there was risk management failure within a particular organization? So then what are they and how are you going to be able to identify these risk management failures? But we're going to be looking at it in detail when it comes to unit 1.5. Then unit 1.4 looks at the case study of ComAir. And when it comes to the case study of ComAir as well, you will see that with ComAir, their IT system had failure where they didn't even know because of the weather conditions in most of these Western countries as well, like for example, especially those countries that have snow. They also give us this case study of ComAir as well, where they are to reschedule their bookings because of bad weather. And they didn't even know that the system had a particular limit when it comes to the number of bookings that it can take over a given period of time. So there was now chaos in the sense that the system ended up was no longer able to was having failures because it had reached its limit when it comes to bookings that it can make over a given period of time. And now because of bad weather, they couldn't even coordinate their own the pilots and the air hostesses as well to make sure that planes are able to take off on time as well because of the issue of what? Bad weather. And this is another case study of what? Risk management failure as well. So you can see that it is a risk management failure in the sense that they were not prepared for these eventualities as well. And that's another case study that is also of interest as well when it comes to the case study of COM-A. So these case studies are there. Please go to these particular case studies because remember, from a risk management perspective, they also enable you to be able to see exactly and identify. So where was the risk management failure? What are they? And how should you now be able to mitigate them in case they also happen to your organization as well that you're going to be working in as well. So starting at 1.1, 1.2, 1.3, 1.4. Please go over them. Please go over them. Don't go through them in detail, like trying to understand them intricately. Go over them and have a rough understanding of exactly those particular case studies as well. Then from there, the idea is what you have learned, you can now be able to use it as an example in understanding exactly how to answer the application of questions that you're going to be facing, especially when it comes to the exam as well. So please go through these particular case studies, but don't go through them in detail because remember, when it comes to the lecturer will give you a particular case study, and based on that particular case study, they will now expect you to answer questions based on that particular case study as well. So 1.1, 1.2, 1.3, 1.4, go through them, but don't spend too much of your time trying to understand them intricately. Just have a rough understanding of exactly what really are the highlighted points or are the points of interest when it comes to those particular case studies as well. Are there any questions so far? Any questions?
Just a question. So to this 1.1, 1.2, do they have answers or it's just more questions?
You see, how normally when it comes to articles, when we go through them, we also, for example, when you look at these self-assessment questions there, right? When we go through these articles, the reason why we highlight things in those particular articles is mainly because they are already answering these self-assessment questions. So whatever we highlight, because remember when you have access to our website and you download the articles as well, the things that you download in the articles are based on the self-assessment outcomes. So that's basically what guides us to say, so based on these self-assessment outcomes, these are the things that we need to look out for in the articles and address them as well. But when it comes to unit 1.1, 1.2, 1.3, 1.4, I wouldn't say they are answers. They are the answers that we have prepared for these particular study units as well. Reason being, it's not questions that we're expecting to encounter, to go through, or to encounter for this particular case study when it comes to the exam as well. So it's not like you're in the exam, you're expecting to be asked questions on ESCOM, or in the exam, you're expecting to be asked questions on HRH, or COM-A, or Bearings Bank in particular. The questions in the exam, they don't come in the exam like that. So specifically for unit 1.1, 1.2, 1.3, 1.4, we don't really, that's why we don't even cover these particular articles in class. Reason being, normally that's not normally how the lecturer asks questions as well. Because remember, when it comes to the questions in the exam, if the lecturer is going to be asking you questions based on a particular case study, they have to give you information for the case study. Then based on that information, then they ask you questions where you're now answering the case study based on things that you've covered from risk financing perspective. Are we on the same page?
Yes, thank you.
All right. So my advice is go through these articles, but don't spend too much time going to these particular articles, because especially if you look at the case study of ESCOM. I think under ESCOM, there are about 3 links for articles that you need to go through. And these 3 links, you'll see that some of these articles, they are like maybe 50 or 100 pages as well. So my advice is go through them, but don't spend too much of your time going through them intricately, because remember, that's not typically how the lecturer would bring questions in the exam. Know them from a risk management application perspective so that you're able to identify cases where risk management would have failed, and how you would actually be able to remedy or even avoid situations which results in what risk management failures. But when it comes to preparation for the exam, don't spend too much of your time going through these particular articles. Are there any other questions? Please note that after today's class, we are giving students a 7-day trial period where after this class, if you go on our website and you create a user account under student login, if you create a user account, then you send me a WhatsApp message with the modules that you want to be linked for, we will give you access for 7-day period so that you also go through the articles and see exactly how and also the videos of the previous year. Because remember, all our sessions are recorded, which means that you are able to access the videos of what we covered when we covered the material from last year as well. You are able to access all that information. So over the 7-day trial period, you are able to go through the video, go through the articles so that you can see exactly how we cover these particular articles as well. So I would advise you to say, and remember, this is all for free. Now, after the 7-day period, try to ensure that during that particular period, if you are happy, you can now indicate to us that you want to officially register with us. Then once you're officially registered with us, it basically means that after the 7-day period, you are still able to now, we can now consider you to have what? To have been enrolled with us so that you're able to what? Continue with your classes as well. Then when it comes to your fees, remember, you can pay your annual fee, break it down into monthly installments. And when you break down these fees into monthly installments as well, even if you register now, you don't necessarily have to pay your installment now. You can even start paying your installment at the end of what? Of the month as well, because we know that some people, they are going to be waiting for their paydays for them to be able to make their monthly installments as well. So even if you register now with us, we will still keep you on our record. Then you can start what? Making your installments as well at the end of the month. We are not that fussy when it comes to the payments, as long as you can see that you are showing commitments to be able to pay your fees as well. So what you can do after this particular class, you can create a user account, send me a WhatsApp message indicating the modules that you want to be linked for. Then we'll link you for those particular modules so that you can also already start studying towards those particular modules as well. And remember, in the coming periods as well, we are going to be, I think our next class is going to be this coming Saturday as well, because remember, normally, we would have started our classes in March, but because there was a delay in late registrations as well, we had to wait and delay our starting of the classes as well. And because of that, you will see that during the month of April, I think the first 3 weeks of April, we are having classes every weekend as well, so that we're able to catch up, so that whatever happens by end of October, we should be done with going to the study units. Then November, December, January, and February, we are going to be concentrating purely on revision, where we go through the reviewing the current year's assignments, going through past question papers, and also revising topics and previous assignment questions, which we see to be of interest and likely to be examinable as well. Are there any questions? If there's any question regarding the installments, how the installments work, remember, once you register with us, we send you an invoice, and on the invoice, it will confirm your annual fee, and it will also confirm your annual fee, and this is where you will also see our banking details as well. And how you make the payments, we prefer that either you do a direct deposit or you do an EFT. And when you do the payments as well, you just need to indicate your name and surname so that we also link your name and surname to the system as well, so that we acknowledge your payments as well. And each module, we charge 1,000. Sorry, we charge 2,500, which is the annual fee, and this covers assistance with the study units, assistance with the assignments, and also revision as well. And remember, once we create the user account on our website as well, you will be able to use last year's videos to prepare for the coming prepare for the coming classes as well. Like, for example, if we are going to be going on to start Unit 4, we make sure that the video for Study Unit 4 is already there, so that you use this video to prepare for the coming class, so that when we do the class, it's more like we are now revising, where if there's things that you still didn't understand, you can now be able to ask questions. I prefer that students ask questions, because remember, if you don't ask questions, I wouldn't know what are you struggling with and what are you not struggling with as well. So please, I would advise you to try as much as possible to utilize the videos that we covered last year, because you're able to use these videos now to prepare for the coming class, so that during the coming class, you will now be able to say, these are the things that I didn't understand. So when I go through that particular study unit as well, you will be able to ask questions, then I can explain in more detail as well. Are there any other questions? All right. So moving on to study unit 1.5. Study unit 1.5 looks at risk management failures. What are they? So study unit 1.5 looks at risk management failures. What are they, and when do they happen as well? So please note that for study unit 1.5, I'm just going to introduce you to study unit 1.5 until 9:20. Under normal circumstances, our class is a 3-hour class, but now halfway, which is about 1.5 hours into the class, we always take a 10-minute break, because remember, we need to make sure that you refresh your concentration span as well. So halfway through every class, we always take a 10-minute break. Then after the 10 minutes break, we can now resume the class as well. So at 9:20, we're going to be taking a 20-minute break. Then at 9:30, we're going to continue with study unit 1.5 as well. So please expect that. So remember, we said when you look at the case study that you are going to be looking at, from study unit 1.1, where you look at ESCOM, 1.2, where you look at Bearings Bank, 1.3, where you look at HIH, and 1.4, where you look at COME as well, right? You will see that one common thing that you have is that there was elements of risk management failures. So you need to, so as a risk manager, you need to be able to identify and answer the question to say, so what are these risk management failures? And how do you know that these risk management failures have already happened as well? And one case study that they use to answer this question on what are risk management failures and how do you identify that they've happened as well, they give us a case study of LTCM. So they give us a case study of LTCM. And when it comes to this particular article, the lecturer says, the article says, the author of the article says, this article does not examine the subprime financial crisis or problems of financial institutions during the crisis directly. Rather, it is an attempt to make sure that if risk management is blamed, it is for the right reasons. So it therefore shows when bad outcomes can be blamed on risk management and when they cannot. In the process of doing so, I provide a typology of risk management failures. So which means When it comes to this particular case study, the author is trying to highlight a very important element to say when there are bad outcomes that arise from a particular organization, these outcomes, are they necessarily going to be blamed on the element to say the outcomes were bad because there was a risk management failure? This question or this element is also going to be explained in detail when we look at study unit 2.8. Because we're basically saying, as an organization, you need to be able to understand exactly, so which situations can we say there was a risk management failure because there was a bad outcome? Because remember, bad outcomes are not always going to be as a result of what? Risk management failures. Because remember, when we are going to look at it in more detail, when you look at unit 2.8, where we're saying organizations, they make decisions under uncertainty. And we're going to look at it in more detail as well when you look at study unit 4. So because you're making decisions under uncertainty, it's like a toss of a coin. These decisions that you're making, it can result in a success or it can result in a failure. So which means now, this result of a failure, is it because of the outcomes of exactly what has happened in the economy or in the market as a whole that is resulted in this particular failure? Or is it because of what? There was lack of what? There was a risk management failure in that case. So that's basically what this article is trying to address. So which means in the article, they highlight the case study of long-term capital management, which is LTCM. So whenever I give you an acronym of LTCM, I'm referring to the company which was called long-term capital management. So here they say, under the headline, was the collapse of long-term capital management a risk management failure? Now, they say, before it collapsed, so they're giving us a brief background of exactly what was happening within this particular company, which is LTCM. So they say, before its collapse, I'm always going to be reading on the highlighted sections as well, because those are the sections which we deem to be important. So here they say, before its collapse, LTCM had capital close to 5 billion, assets in excess of 100 billion, and derivatives for a notional amount in excess of 1 trillion. By mid-September, LTCM's capital had fallen by more than 3.5 billion, and the Federal Reserve Bank of New York coordinated a rescue for private financial institutions that injected 3.65 billion in the fund. So does a loss of more than 70% of capital represent a risk management failure? Does a loss that requires a rescue by banks involving an injection of 3.65 billion of new capital show that risk management failed? So it turns out that it is not easy to answer these questions. So to define a risk management failure, one must first define the role of risk management. So in a typical firm, the role of risk management is first to assess the risk faced by the firm, communicate these risks to those who make risk-taking decisions for the firm, and finally, manage and monitor those risks to make sure that the firm only bears the risk its management and the board of directors want it to bear. This statement is very, very important because remember, it gives you a range of exactly what are the responsibilities and the duties of a risk manager. So the duty of the risk manager is not to make a decision to say, so as a firm, should we only take a maximum of conservative risk investments? Should we only take a maximum of moderate risk investments? Or should we only take a maximum of what? Aggressive risk investments as well. So which means this decision is not the duty and responsibility of the risk manager. The risk manager's responsibility is to identify the risk exposures of the organization, to say, so their responsibility is to bring light or to shine light to say, these are the risk exposures that we're likely to face. And based on these risk exposures, this is how much risk we're going to be exposing ourselves to if we take this particular route as well. Then the management and the board, their responsibility is now to say, based on exactly, because remember, based on what we deem to be the goal of the firm, and based on exactly what our target returns are, then this is how much risk we should be exposing the organization to. Then, after being given this range of risk exposures that the organization should strictly adhere to, it is now the duty and the responsibility of the risk manager to ensure that the activities that are going to be done within the organization, they fall within the set risk limits. So that's basically, that would be the duties and responsibilities of the risk manager. Please take note of this, because I've seen this particular a question linked to this being asked last year when it comes to assignments. And I think I've seen a question related to this as well being asked in one of the multiple choice questions in the GenFeb exams as well. So please take note of this particular statement. Are there any questions when it comes to this statement? Now, in the article, they also go on to say, because firms are generally more concerned about unexpected losses, a frequently used risk measure is value at risk, which is, in short, it's given as VAR, a measure of downside risk. So the value at risk is the maximum loss at a given confidence level over a given period of time. Now, this statement is very, very important. Remember, we're saying this is the maximum loss the organization is expecting to suffer over a given period of time. Now, one of the shortfalls that LTCM had is that they were operating a hedge fund. So one of the shortfalls that they also had was that when it comes to the risk elements that their investments were exposed to, the value at risk was not the right risk measure that they were supposed to be using as a risk measure as well. So because of this, it basically means that this is why you find that their losses end up compounding as well, because they were not using the risk measure when it comes to their risk exposures as well. Now, when it comes to value at risk, for Rsk4803, just know what value at risk is and what it measures. When it comes to the actual calculation of the value at risk, we don't worry about it for Rsk4803. The actual calculations of the value at risk, we are going to be looking at it in more detail when it comes to market risk, which is RISK 4805. That's when we look at it in detail to say, how do you calculate the value at risk and how do you measure now the overall risk exposure as well, given a confidence level as well. So this measure of value at risk, they are basically saying that this measure might be estimated daily or over longer periods of time. So you can calculate the value at risk on a daily basis, or you can even calculate the value at risk over a longer period of time. Like, for example, you can now be able, from from the daily value at risk, you can now be able to use it to estimate your value at risk over a longer period of time, like for example, over 4 days, over 90 days, or whatever period of time that you're going to be given as well. So which means, in this case, they say, using value at risk, they had worked out that 99% of the time, so they were 99% confident, they would earn an average return of about 25%. So they were confident that 99% of the time, they were going to be able to earn an average of 25% return based on their calculations. So if you now explain it in years, right? They say explaining it in years, it means that 99 years that the return would be positive, and 1 year, a loss in excess of 20 would be expected. So they are basically saying that over a 100-year period, in 99 years of the 100-year period, we're expecting to earn an average return of 25% positive returns. Then 1 year of those 100 years, that's when we are expecting to suffer a loss in excess of what? 20%. So that's basically what their calculations were showing them when it comes to based on the calculation of what? Value at risk. Now, the author also going to say, deciding whether to take a known risk is not a decision for risk managers. The decision depends on the risk appetite of an institution. However, defining the risk appetite is a decision for the board and top management. So that decision is at the heart of the firm's strategy and of how it creates value for its shareholders. Remember what I said? The goal of, so whatever you do when you look at this particular module of risk financing, remember what you've learned when you're studying financial management, where we say, what is the goal of the firm? The goal of the firm is to maximize shareholders' wealth. So how do we maximize shareholders' wealth? It basically means that in the short run, we want to maximize our benefits and minimize our costs. So if we maximize our benefits and minimize our costs, in the long run, that's when we're going to be able to maximize the share price. And the share price is now going to be linked to the firm value. And the higher the firm value, the higher the shareholders' wealth as well. So in this case, they're basically saying, looking at this case study, here they say, for instance, having to scale back its investments because of being financially constrained, and to sell assets in unfavorable markets, lose valuable employees who become concerned for their bonuses, lose customers who are concerned about the institution being distracted and not having sufficient resources to help them, and face increased scrutiny from regulators means that the company would not be able to maximize the shareholders' wealth. And remember, this is the risk that the company, that the institution is now going to be faced with in the case where they suffer a huge loss. Remember, we said their estimation using the value of risk was that 1 year of the 100 years, we are expecting that we're going to be suffering losses in excess of 20%. Now, if that 1 year you suffer losses in excess of 20%, remember we're saying in excess of, it means what if the losses are going to be 50% of your value? What if your losses are going to be 80% of your value? It basically means that that huge loss, those huge losses are now going to end up affecting the organization. And the moment the organization suffers those huge losses without having in place measures to ensure that they're able to mitigate those losses as well, what is going to happen? The organization is not going to be able to continue as what? As a going concern. Which basically means that these losses that LTCM ended up suffering as well, even if they were saying that it's only going to happen in 1% of the time, if it happens, you don't know exactly when this loss is going to happen. Is it going to happen after 1 year? Is it going to happen after 6 months? Is it going to happen after 20 years or after 15 years? You don't know. But when that loss happens, if the organization now ends up suffering huge losses What's going to happen when those losses happen? It basically means that those losses might end up affecting what? The going concern of the business. And this is basically what ended up affecting LTCM as well. So because of these huge losses, they say at the end of 1997, LTCM had capital of 7.4 billion, but decided to return roughly 36% of the capital to its investors. With less capital, LTCM could still execute the same trades. However, now to implement them, it had to borrow more, and hence it had to increase its leverage. By increasing its leverage, it could boost the return of its shareholders if things went well, at the expense of making more losses if things went poorly. So was increasing a leverage a poor risk management decision? So which means in this case, when it comes to leverage, remember we're saying that the financing of the firm is going to be your assets is equal to equity plus liabilities. So the more liabilities you use, which is debt, the more debt you use, the more risk that you have that you're going to be able to fail to meet your obligations when they fall due, if what you're not going to be able to, if the business goes south as well. So which means in this case, increasing leverage has an exponential effect of increasing returns, and also at the same time has an exponential effect of increasing losses as well. So now what do we see? The company is highly leveraged where they've bought back their equity capital. So they've bought back the equity capital from the investors. Now, because they've bought back the equity capital from investors, they have managed to increase the return on equity for the investors. But at the same time, if they bought back the equity capital from the investors, it basically means that the company now has a big chunk of their financing through debt financing. And we know exactly what happens if anything goes wrong in the market when companies are highly leveraged. What usually happens? We have seen it in the case of the recession during the 2007-2008 financial crisis, where companies that were highly leveraged are the ones that failed to sustain and ride through that wave. And we've also seen it as well during the period where we had the pandemic, where companies that were highly leveraged during the pandemic, they were unable to sustain because remember, your revenue has gone down, you have all these financial obligations, and you're not able to meet these financial obligations as well. And we are also seeing it quite a lot, especially when it comes to even the financial institutions and banks in the US as well. As you've seen, what happened last year when you look at the case of Silicon Valley Bank and all those other institutions as well, where organizations which are highly leveraged, usually where the more debt you have, the higher the chance that you are not going to be able to meet your financial obligations. And if anything wrong happens when it comes to your income generating activities, where you suffer losses, if it's banks, you have the run for the bank, and then the bank end up facing possible closures as well. And we also see it as well quite a lot when it comes to the economy going through downturns, where if the economy goes through a particular downturn, like what we see in the trucking industry in the US as well, where a lot of companies which are in the trucking industry in the US, they are facing bankruptcies. Why? Because the rates that they're earning per mile are very low. And because of that, what do we see? They're not able to generate as much revenue as they used to. And at the same time, they are highly leveraged such that they're not able to continue as a going concern because they are having all these, for example, fixed expenses and also fixed interest obligations as well that they have to cater for and not having enough income to meet those expenses as well. So this is the same case that you're also seeing when it comes to LTCM, where they are now we see that they're in a position where they are highly leveraged, and at the same time, they are using the wrong measure when it comes to assessing their risk exposure as well, where they are using value at risk as a measure as well. Because remember, normally value at risk is ideal as a risk measure for banks. But now, even when you look at value at risk, we're going to look at it in detail as well, where there are other measures that there's another measure that you can also use, which is even a bit more reliable as well than value at risk. But remember, value at risk is more reliable when it comes to as a risk measure for banks, but not necessarily for what? For hedge funds as well. So you see that in this case, LTCM is highly leveraged and they're using the wrong risk measure as well. So going forward, they also say, so in summary, risk management does not prevent losses. So with good risk management, large losses can occur when those making the risk-taking decisions conclude that taking large, well-understood risk creates value for their organization. So which means just because you have a risk management process in place does not necessarily mean that you are going to be able to prevent the losses. So which means you are also depending on your risk appetite, you are still going to be exposed to your risk exposures. But the key now is to say, if you are now having the high risk exposures, risk management failure would be where you're now going to say, yes, we have taken a risk exposure, a large risk exposure, but now what have we done to prepare in case those loss events happen? So this is basically where you now going to be saying, so was there risk management failure or there was no risk management failure as well? So which means that we should know that risk losses are always going to happen. Risk management failure is where you fail as an organization to prepare to identify those possible losses that might happen and also prepare your organization for those possible losses as well. So are we on the same page when it comes to a summary of the case study of LTCM? But remember, based on this summary, we are now going to be looking at the typology of risk management failures to say, so what really are risk management failures? How do we identify them? And what can we do to mitigate those risk management failures as well? Are there any questions so far?
Yes, Rhinos, just a quick one. If we now say LTCM is highly leveraged, what should one understand this to mean in totality? Thank you.
When a company is highly leveraged, remember your accounting equation, you say your assets is equal to equity plus liability. So from your assets, these are the ones that you are using to what? For income generation, right? Because your aim is to generate a return. But to generate this particular return, so this is where, so from on your asset side, this is where you make investment decisions. Then on the equity and liability side, this is where you make financing decisions. So when you look at your accounting equation, on the left side, on the asset side, this is where you make an investment to say, so what are we going to be investing in as an organization? Are we going to invest in Uber? Are we going to invest in property? Or what are we really going to be investing? So on the left side of the accounting equation, you make investment decisions. But now, to invest in this, how are we going to be financing it? Are we going to be financing it through contributions from the owners of the business, which is basically your equity capital? Or are we going to be financing this through liabilities, which is your debt? And remember, typical examples of your debt would be, for example, you're getting a loan and you're issuing bonds as well. Right? Before I get lost, your question was in connection with?
What I wanted to ascertain, because I think you made a statement to say that LTCM was highly leveraged. So for my benefit, I want to understand what is actually meant when we say a company is highly leveraged in totality.
Okay. So leverage is basically use of debt. So the use of debt is leveraging. So the more debt you utilize, the more leveraged you are as an organization. But now, the risk to you as an organization is that if an organization is highly leveraged, right, what do we see? It means if you're able to use debt financing, it means that you are this use of debt basically comes with what fixed cost obligation. So the use of debt comes with fixed cost obligations. Like for example, whether you make money or not, you have to pay interest when it falls due. Whether you make money or not, when the debt reaches maturity, you have to repay that particular debt as well. So this is basically what it means. So which means debt, use of debt, when your debt is increasing, it means your financial risk. So when you're highly leveraged, it means your financial risk is also high. So the higher the debt, the higher the financial risk of the organization. So when you say LTCM was highly leveraged, you're basically saying that they were using high amounts of debt, and the more debt you have, the more financial risk because you're having what? A lot of fixed cost obligations. Because remember, whether you make money or not, you still have to pay for those fixed costs as well. Are we on the same page?
Well explained. Thank you so much.
All right. Okay. Are there any other questions? All right. Can we take a few minutes break until 9:55? Can we take a few minutes break until 9:55? Then at 9:55, we continue with the article. So can we take a few minutes break until 9:55? All right, can we continue? So now we are continuing with unit 1.5. Now, before we continue with unit 1.5, please take note that for assignment one, generally it's quiz type of assignment where it's the quiz type of assignment where you find that the type of question that you find in the quiz type of assignment is like more like housekeeping type of questions as well, so that you understand exactly what is risk management, what are the topics, what you get, any of these housekeeping type of questions. Generally, this is the type of question that you should expect from quiz one of Rsk4803. So how we usually approach quiz one of Rsk4803, normally it's those questions that enables you to guide you so that you're able to know exactly how to go about the module, but not necessarily things that you should expect to encounter in the exam. So normally that's how quiz one is structured. So how we usually approach quiz number one is that I will look at the questions that are there. Then I'll create a database of the questions that you're going to be encountering. Then I'll share the database of the questions. Now, you as a student, what they usually do is that for quiz number one, usually the questions are the same, but the numbering of the questions is what might be different from one student to another as well. So what I'll do is that I'll create a database. I see that quiz number one for Rsk4803 is due on the 29th of April, which is the end of this month. So in the coming week, I'm going to be preparing the database of answers that are relevant for quiz number one, so that by the end of the week, I will share with you the answers for quiz number one, so that you are able to attempt quiz number one of Rsk4803. So which means that during the course of the week, I'm going to prepare the database and share that database of answers with you as well, for those who would have registered as well. Then in the next coming class, remember, because we're trying to catch up, this coming Saturday, we are going to be having a class. But as we're going to be having a class for this coming Saturday, we're going to be continuing with Unit 1.6, then move on to start Unit 2 as well, and continue with the curriculum. Because remember, for quiz number one, it's basically those random questions which are meant not necessarily for you to prepare for the exam, but for you to show that you have an understanding of exactly what can you get and where and what is expected of you when it comes to Rsk4803. So I'm going to create a database of the answers, and then I'll share that particular database with you. Remember, the questions are randomized, but you now have to say as an individual, what question am I asked in question number one? Then you look for the question and answer for that particular question in the database that I'm going to share with you. But normally, quiz number one, it's things that you are normally expected to know. I will look at the questions, but usually it's things that you're expected to know, because normally quiz number one, I'm very wary of giving those questions, the answers to students, because it's like when you're going to be asked how many topics are covered in Rsk4803. As a student, you should know how many topics are covered. That's basically what you're expected to know. So these are basically the housekeeping type of questions which are asked in assignment number one. I'll share the answers with you, but I'll have a look at it. Then I'll discuss with you guys on the different WhatsApp groups as well during the course of the week. Please ensure that during the course of the week, you also join the different WhatsApp groups as well, so that you make sure that it's easier communicating with you through the WhatsApp groups, because I know that I'm broadcasting everything to everyone within the class as well, so that no one is actually going to be falling through the cracks. So now moving on to continuing with Unit 1.5. Remember, we had looked at the summary of LTCM, And the main issue that we wanted to address is, what are risk management failures? What are they and when do they happen? And to try to understand that issue of risk management as well, where we say, so are we going to say there was a risk management failure or not when it comes to the negative outcomes that have resulted in a particular organization as well? We look at a typology of risk management failures. So under this section, I only go through the highlighted sections because these are the sections that I deem to be important. So under the section which looks at the typology of risk management failures, they say two types of mistakes can be made in measuring risks. Known risks can be mismeasured and some risks can be ignored, either because they are unknown or viewed as not material. So once risks are measured, they have to be communicated to the firm's leadership. Remember, we said that we looked at in the previous section, we looked at the roles and responsibilities of the risk manager. Then now they also go on to say, a failure in communicating risk to management is a risk management failure as well. After management decides what kind of risk to take, risk management has to make sure that the firm takes these risks. So in other words, risk managers must then manage the firm's risks, a task that may involve identifying appropriate risk mitigating actions, hedging some risks, and rejecting some proposed trades and projects. And lastly, a firm's risk managers may fail to use appropriate risk metrics. So with this perspective, there are 6 types of risk management failures. So looking at these 6 types of risk management failures, remember we said for us to say this negative outcome was because of risk management failures, we now need to find out exactly, so is it going to be, so for you to now blame risk management to say risk management is failed because of this negative outcome, we now need to check to see exactly this failure, is it as a result of any one of these types of risk management failures? I have to say, yes, it was because of risk management failure before, or else it would be as a result of something else. So when it comes to the 6 types of risk management failures, the first risk management failure that they talk about is mismeasurement of known risks, and we're going to look at it in detail. And the second risk management failure is failure to take risks into account. Then the third one is failure in communicating the risks to top management. And the fourth one is failure in monitoring risks. Then the fifth one is failure in managing risks. And then the sixth one is failure to use appropriate risk metrics. So these are the 6 risk management failures, and we're now going to look at them in detail. So looking at the first one, where we look at mismeasurement of known risks. They say risk managers could make a mistake in assessing the probability of a large loss or the size of the large loss if it occurs. However, in addition, they could use the wrong distribution altogether. So for example, they can use a binomial distribution where they're just supposed to be using the normal distribution as well. So a simple way to put this is that correlations may be mismeasured. So correlations are extremely important in risk management because the benefits of diversification falls as correlation increase. Now, what do they mean by correlation? When you look at correlation, So when you look at correlation, we generally say the correlation coefficient varies between -1, 0, and +1. So the correlation coefficient always is going to be falling within these particular ranges. When the correlation coefficient is +1, we say the assets or the return of the assets is perfectly positively correlated. And if the correlation coefficient is at -1, we say it's perfectly negatively correlated. And if it's 0, we simply say there's no linear correlation. Now, to explain what we mean by the correlation being perfectly or positively correlated, we use an example of the return between two assets over time. So over time, we look at the return between two assets. Let's say, for example, you have asset M. Asset M, the returns are moving in this particular pattern. If the returns are perfectly negatively correlated, it means when asset M's returns are increasing, let's say, for example, you have another asset, which is asset N. So if asset M's returns are increasing, asset N's returns are decreasing. So they're basically moving in the opposite direction. And if it's basically exactly the same pattern, but in opposite direction, if it's exactly the same pattern, but in opposite direction, we say it's perfectly negatively correlated. But if this relationship is basically moving in opposite direction, but not exactly the same, we simply say negatively correlated. So if they are moving in the opposite direction, but not exactly behaving the same, we say simply they're negatively correlated. Then, when you look at positive correlation, remember we said we're looking at the returns of these two assets over time. If they are negatively correlated, remember we have asset M moving in this direction. If they are positively correlated or perfectly positively correlated, we're basically saying that when asset M's returns are increasing, asset N's returns are also increasing. So if they are moving in exactly the same pattern, even if asset M is at a higher return or asset N is at a lower return, if they are moving in exactly the same pattern, mine is not exactly the same, but if they are moving in exactly the same pattern, we say they are perfectly positively correlated. If it's the same pattern, but not exactly the same, we simply say they are positively correlated, simply positively correlated, which means if you are saying they are simply negatively correlated, it's anything within this range. That's when you say they are negatively correlated. If it's anything within this range, we simply say they are positively correlated. Now, if the returns of these assets, when you look at these returns of these assets, so we have the return over time. So if the returns of these assets, there is no pattern that you can figure out. Like, say, for example, these returns are just random. there's no pattern that you can figure out when it comes to these particular returns. If they are purely random in nature, that's when we say there's no linear correlation. So if the performance of these returns of these assets between asset M and asset N, if there's no pattern that you can try to figure out within them, that's when we say there's no linear correlation. Are we on the same page before we look at the issue of diversification? Now, when you look at risk, remember we said our goal is to maximize the returns and minimize the cost. At the same time, which we're going to be looking and explaining in detail in study unit 9 as well, when it comes to risk, you want to make sure that you minimize your risk as much as possible. So if you're having a portfolio of two assets, of asset M and asset N, right? Asset M and asset N. Your asset is exposed to too much risk when the assets are performing in the same direction. Like, for example, if your assets are perfectly positively correlated, it means if you invest in these assets, let's say, for example, this is period 1 and this is period 2. If you invest in these assets, what is going to happen? During this period, they are both having a downward trend. They are suffering losses. The returns are decreasing, isn't it? So if you invest between period 1 and period 2, and you invest in assets M and N in your portfolio, if they are perfectly positively correlated, what does that mean? Overall, your portfolio is going to be suffering a loss, isn't it? Now, if you invest in assets M and N during this particular period as well, what do we see? The losses that are suffering from asset M are going to be covered by the gains that you're getting from asset N. So which means the more you are going in this particular direction, we say the more diversified your portfolio is. So which means diversification increases the more you go in this direction. So this is the direction for diversification. And we will look at, you can also compare it as well when you look at the correlation coefficient, when you look at the overall risk of a asset portfolio as well. You will see that the more the correlation coefficient goes in this direction, the more the standard deviation decreases. So the more you go in this direction, your standard deviation is going to be decreasing for your two asset portfolio as well. Because of what? Because when correlation goes towards -1, the more diversified your portfolio becomes. Are we on the same page?
Yes.
So can we move on? Now, so looking at what they're covering, so that's basically what they're trying to highlight when it comes to the first one. Remember we said that when it comes to the first one, we said that the issue here is where we need to look at the concept, the issue of what? We're looking at the issue of correlation, where you look at mismeasurement of known risks. So you know exactly what your risk measures are, but if you mismeasure or you don't correctly measure those risks, what is going to happen? It basically means that you are going to understate your risk exposures. And if you understate your risk exposures, you're going to be running a risk the way you're now going to say, you are expecting that my maximum loss should be, for example, 25 million in my portfolio. Then you end up seeing that because you mismeasured your risk, you end up suffering what? A loss of, let's say, for example, 50 million as well. So mismeasurement of known risk can also result in what? Risk management failures. So here they say, with the LTCM example, it could be that the true probability of a loss of 70% was higher than 1%, say 25%. Which means in this case, the probability, remember we said when they were using the value at risk, they were expecting that over a 100-year period, they were all in 1 year of the 100 years, that's when they were going to be suffering that risk as well of a loss of what? Of that loss of what? Of whatever, of more than 20%, isn't it, right? Now they're basically saying that because they mismeasured a non-risk exposure, it basically means that when it comes to look at the case study of LTCM as well, they are basically saying that because they mismeasured a non-risk exposure, it basically means that they ended up understating their risk exposure, where they were just saying that the probability was basically just 1% of the time, when it actually the probability of having that loss of 1% of suffering that loss in 1% of the time was actually what 70% high. So that's the first case where you can say there was a risk management failure. So here they say, when an institution has many positions or projects, the risk of the institution depends on how the risk of the different positions or projects are related. So if the correlation between the positions or projects is high, it is more likely that all the firm's activities perform poorly at the same time, which leads to a higher probability of a large loss. So these correlations can be difficult to assess, and they change over time, at times abruptly. So which means mismeasurement of non-risk, they're basically saying that they basically understated the possible correlations between the performance of the assets that LTCM was invested in as well, which basically means that during that 1% of the time that the loss happened, they also forgot that even if it happens 1% of the time, because of correlation, the level of correlation also increases what? The amount of the loss that they're going to end up suffering, which ends up affecting what? The going concern of the organization. So here they also say, so in this case, the risk managers could not be expected to know what correlations would be, but their assessment of the risk of a portfolio or of the firm would depend on their estimates of the distribution of the correlations. So in this case, it would be possible for realized correlations to be different from their expected value, and yet there would be no risk management failure. So historical data is at times of little use because a known risk has not been manifested itself in the past. For instance, with the subprime crisis, there was no historical data of a downturn in the real estate market during which a large amount of securitized subprime mortgages was outstanding. So in such a situation, risk management cannot be done by simply using historical data, since there is a risk of a decrease in real estate prices that has not manifested itself in the comparable historical period. So here they're basically saying that when you look at the 2007-2008 financial crisis as well, they're basically saying that it was not going to be reliable for us to use historical risk exposures as well if you're going to be invested in real estate. Reason being, before the 2007-2008 crisis, there was no previous non-recorded historical subprime crisis. The one that was before that was the dot-com crisis. I think it was around 2000, 2001 as well. So because of this, it basically means that it would be very difficult now to measure that your risk exposure, because there's no historical data that is available. Even if there's historical data as well, there are so many things that could have changed, which means that the elements could also possibly change as well. And then they're also going to say there's a fundamental problem with the performance of risk management measurement when assessments become subjective. Suppose that all parties agree that an established statistical model works well, which means in this case, in addition, then a risk manager establishes a question and questions the reliability of the statistical model used by experts in the field concerned, which means that in this case, you also have a situation where people can also agree to say, this is the model that we're supposed to be using. But then the risk manager starts questioning the reliability of that instrument as well, especially when it comes to the financial market as well, where information comes in very quickly and changes very quickly as well, which basically means that you are going to be having a situation where you are, as a risk manager, you are going to be bogged down in situations where you are checking the reliability of the risk measure instead of actually using that particular risk measure as well to keep up with the changes in market conditions as well. So here they also go on to say, so as risk management moves away from established quantitative models, it becomes easily embroiled in intra-firm politics. So at that point, the outcome for the firm depends much more on the firm's risk appetite and on its culture than on its risk management models as well. Are there any questions when it comes to the first risk management failure? They also look at mismanagement due to ignored risks. And yet they say ignored risks can take three different forms that have different implications for a firm. First, a firm may ignore a risk even though that risk is known. And second, somebody in the firm knows about a risk, but that risk is not captured by the risk models. And third, there is a realization of a truly unknown risk as well. So this also can end up resulting in mismeasurement of the risk exposure as well, because you have not been able to account for these risks as well. Now, when you look at ignored known risks, they go on to say a good example of this possibility is as follows. Before Russia defaulted on its domestic debt in August 1998, many hedge funds took positions where they bought high-yielding Russian debt, hedged the debt against default risk, and finally hedged the debt against exchange rate risk. So it is easy to believe that the resulting position had no risk. However, to hedge the currency risk, the funds had to sell rubles forward against the dollars. Now, which means in this case, even though it wouldn't have made much difference, as the Russian banks still went down, you find that LTCM didn't even take the step to try to hedge that particular risk as well, where you are basically saying that the party who's selling your risk might also end up defaulting on their obligations as well. The next risk management failure looks at mistakes in information collection. And here they say, if some risks are not accounted for when risk is measured for a firm, the risks left out are not adequately monitored, and they can become large because organizations have a tendency to expand unmonitored risks. For instance, consider a trader whose risks are only partly monitored. So typically, traders who have a compensation formula that involves an option payoff, so they receive a significant share of the profits they generate, but they do not have to give back the losses. So if only some of the risks a trader are monitored, he can increase his expected compensation by increasing the risks that are not monitored without suffering any of the consequences. Of course, remember, for example, that's why you find that many financial organizations, when it comes to traders, they use a method, what we call high watermarks, to ensure that they are not going to be paid immediately for the positive returns for the compensation of bonuses for when they outperform a particular benchmark as well, mainly because a trader can end up saying, if I'm going to be monitored on these particular risks, but I'm not going to be monitored on these particular risks, they are now going to be in trading instruments with the risks exposures which are not monitored. And because of that, it basically means that their risk levels end up being higher than what is supposed to be the risk levels within the overall organization, which basically means that if the losses happen, they don't suffer the loss, but if they make a gain, they are the ones who are going to be paid the bonus as well. So here they say, accounting for all the risks in risk measurement is a difficult and costly task. However, not performing that task for an organization means that the firm's top executives are managing the company with blinders on. They see only part of the big picture that they have to understand to manage effectively as well. Are there any questions regarding failure to collect the data? Next, we look at unknown risks. And here they say, other unknown risks may not matter simply because they have a trivially low probability. So there is some probability that a building will be hit by an asteroid. So that risk does not affect any management decisions. So ignoring this risk has no implication for risk management. But because of this, they have to conclude that they do not capture all risks in their models, and therefore some capital has to be made available to cope with unknown risks. That's why you see that many models which are formulated when it comes to risk measures as well, they always take into account an element of what they always take into account an excess element, which means that whatever amount that you're saying that you're going to be catering for as well, you also need to cater for that, the unknown risk, by accounting for the excess element as well. Another risk management failure would be due to communication failure. And yet they say risk management is not an activity undertaken by risk managers for risk managers. Rather, it is an activity undertaken to enable the firm to maximize shareholders' value by taking optimal decisions across the firm. So therefore, risk management has to provide timely information to the board and top management that enables them to make decisions concerning the firm's risks and to factor the firm's risk in their decisions. So in order for the board and the top management to understand the risk situation of the firm, this situation has to be communicated to them in a way that they can understand properly, which means failure to communicate the risk exposures of the organization is also going to be a risk management failure, mainly because you are talking the risk element with the board. And remember, usually the individuals who usually make the board are not risk managers. Some of them, they have different qualifications from different backgrounds as well. So which means that failure to actually properly communicate the risk exposures of the organization means the risk takers who are going to be deciding to say, so based on what the information that was provided to us, how do we now decide on the risk exposure that we are going to be taking? Remember we said the risk manager, they identify the risk, then they present the risk exposures to the board. The board is the one that makes the decision to say, so based on the information that was presented to us or communicated to us, this is how much our risk exposure should be, and these are the places that we should take risk on, and these are the places that we should not take risk on as well. And then after that, the risk manager goes on, and then on an ongoing basis, they now review and monitor what the risk exposures that the organization is making as well. So any failure to communicate the risk to the decision makers is basically a risk management failure. Then we also look at failures in monitoring and managing risk. And yet they say, risk management is responsible for making sure that the firm takes the risk that it wants to take and not others. So as a result, risk managers must constantly monitor the risk that the firm is taking. And further, they have to hedge and mitigate known risks to meet the objectives of top management. So for the typical non-financial firm, risks often change slowly. Like, for example, a typical financial firm is like, for example, a manufacturing company, right? So they are not necessarily involved in the day-to-day. They don't expose themselves to financial instruments on a day-to-day basis because what? They are more concerned with what? Manufacturing of goods, right? Or, for example, if you're a farmer, if you're a farmer as well, you see that your risk, basically, they don't change that rapidly when you're comparing a non-financial firm like that compared to a financial firm. So here they say, so not so for financial firms. For a financial firm, risks can change sharply even if the firm does not take new position. So the problem arises for the fact that financial firms have many derivative positions and positions with embedded derivatives. So over time, these positions have become more complex because remember, It's one of the problems that you also saw when it comes to 2007, 2008 financial crisis, where investors in financial firms were investing in, for example, collateralized mortgage obligations, and then which were now being packaged into collateralized debt obligations, which basically means that you are investing in an instrument which has got derivatives. But remember, this derivative, by definition, a derivative is a financial instrument that its return is going to be based on an underlying asset. So it's like you're now having different layers. Now, because if you don't understand what are the different layers that contribute towards the return of the instrument that you're investing in, because it's the derivative, it basically means that if it becomes too complex for an individual now to understand, to say, so if the market goes in this particular direction, how am I going to be affected? Because remember, there are so many different performance of the underlying instruments, which are also going to be contributing towards what? The performance of the derivative as well. So here they say, so when the risk characteristics of securities can change very rapidly, it is challenging for risk monitors to capture these changes and for risk managers to adjust hedges appropriately. So this challenge is especially great when risk characteristics can change dramatically for small changes in the determinants of security prices. So as a result, risk managers may fail to adequately measure risks or hedge risk simply because risk characteristics of securities that may change too quickly to enable these managers to assess these characteristics properly or to put on correct hedges as well. Because remember, we're basically saying that in a financial firm, things are changing by the minute. Things are changing by the hour as well, which basically means that you might start your day where things are calm, but because of changes in economic conditions and because of changing of things around the world as well, it basically means that for a financial firm, those changes, they rapidly come in and affect the financial instruments, which also means that the changes for a financial firm are going to be more rapid than what? A non-financial firm. So they're also going to say, in large complex organizations, it is also possible for individuals to take risks that remain hidden for a while. A trader might have constructed a complicated position that only he understands. So this position might be such that under some circumstances, it could lead to large losses. So the position might use securities that are not incorporated in the risk management system. So which means now, in this case, it means that if the trader understands, especially when it comes to derivatives, that's why you see that, especially when you look at general investments, you will see that hedge funds, not anyone is allowed to invest in hedge funds. That's why you see that, for example, unit trusts, they are very wary of if it's a hedge fund, they have to indicate that it's a hedge fund. Otherwise, mutual funds, they are not supposed to be including any instruments that takes a short position. Reason being, derivative instruments, they end up being too complicated. And if they end up being too complicated, now the issue is you find that the more complicated the position is, it means that whoever is supposed to be supervising this trader to make sure that they're able to remain within the allowed risk range, they are not going to be understanding to say, so based on this position that this trader has taken, does it mean we are still remaining within the risk range? So which means that if the trader takes a position which only them understand, and the supervisor is not able to understand what the trader has done, or the manager is not able to understand the position that the trader has taken as well, it also means that the trader might end up having a situation where the risk exposure might be more than the range that is allowed within the organization as well. So here they say, the effectiveness of risk monitoring and control depends crucially on an institution's culture and incentives. So if risk is everybody's business in an organization, it is harder for pockets of risk to be left unobserved. If employees' compensation is affected by how they take risk, they will take more risk judicially. So the best risk models in a firm with poor culture and poor incentives will be much less effective than a firm where the incentives of employees are better aligned with the risk-taking objectives of the firm. Are we on the same page so far? Any questions? No. So now we look at the last section where we look at risk measures and risk management failures. So at the conclusion, they're basically saying, so far, we have taken the risk matrix as given. We now show that focusing on metrics that are too narrow may make it harder for management to achieve its objectives. Specifically, risks that management would consider important can be left unmeasured and ignored. A widely used risk measure of financial institution is the daily value at risk measure for trading activities. So focusing on the daily market value at risk, though intellectually satisfying for risk managers because the most up-to-date quantitative techniques can be brought to bear on the problem, can only be part of the risk management and not the one that top management should focus on. So top management has to focus on the longer run implications of risk as well, which means that they should not focus on risk measurement and management from an operational perspective. They need to look at risk management and measurement from what? Strategic perspective as well. So here they say, daily value at risk measures assume that the assets can be sold quickly or hedged so that a firm can limit its losses essentially within a day. However, both in 1998 and over the last year, we have seen that markets can become suddenly less liquid so that daily value at risk measures lose their meaning. So if a firm sits on a portfolio that cannot be traded, a daily value at risk measure is not a measure of the risk of the portfolio because the firm is stuck with the portfolio for a much longer period of time. Hence, you need to look at it from a strategic perspective as well. So, when it comes to start unit 1.5, don't worry yourself much about the case study of LTCM, although they highlight the case study of LTCM because they're using this case study to explain, using those examples to explain what risk, for you to be able to identify what are risk management failures and how do you identify them as well. So the most important thing that you need to take note of from unit 1.5 is basically the 6 types of risk management failures. Are there any questions on what we've covered in unit 1.5? Any questions?
I have a question, Mr.
Mm-hmm.
When measuring risk, is it always the case that there is a, how can I put it? There is a system, usually technological system, that makes the measurement rather than a person using subjective assessments to measure the potential loss? Is it always that there's a system that will tell us that the risk is associated to this amount of loss?
Individually, you are able to measure risk. Remember, you look at calculation of the standard deviation. Remember, when you're doing your undergrad, you did look at calculation of the standard deviation, isn't it? Like,
yes.
For example, if it's a 2-asset portfolio where they say the standard deviation of a 2-asset portfolio means that you have to calculate the standard deviation, where you calculate the expected return, then you calculate the standard deviation as well, right? So that's another risk measurement of your particular portfolio as well. So which means it's not always going to be using the systems, but although the systems can be able to do these calculations quicker, especially when it comes to financial firms, where we said that when it comes to financial firms, things are changing quickly.
Rapid.
So because things are changing quickly, that's why you see that now people are using systems. Like, for example, even if you look at traders as well, even when it comes to traders, they even put in ranges to say, if my loss falls reaches the certain maximum, take a position to sell. And remember, you put that particular selling position where even if you go somewhere on holiday, you know that if the market goes wrong, where your losses reach a certain amount as well, automatically the system takes a position to sell as well. So which means that those systems, they are basically there to make our lives easier instead of us doing the manual calculations ourselves, so that we're able to make decisions quicker.
Understood.
All right. Are there any other questions?
One more question.
Yes.
I am struggling to understand how models what role they play in the risk management process. I can understand that scenario and modeling is one of the stages of the risk management process, but how do we implement modeling in our risk management process?
Remember, models are basically formulas, right? You can look at them as formulas. And the reason why we have formulas is mainly because we want to be able to measure our risk exposure. So for you now, remember we're saying that we try, when it comes to decision making, you want to try to be as objective as possible instead of being subjective, because the more objective you have, the more systematic your decision making, or the more consistent your decision making becomes as well. So which means models are basically used to make our decision making more consistent, and it makes our lives easier as well, because models, they help us come up with help us with decision making as well. To say, for example, if a model indicates that your loss is now, because remember, for you to say, for example, this is how much my risk exposure is, you now need to use you can now use your model to enter the inputs, put the inputs into the model. Like, for example, a typical model is where we talked about, remember we said calculation of the standard deviation. That's a typical model. So which means you can use that particular model to now input the data, and then it will tell you exactly how much your standard deviation is. And based on your standard deviation, you can now be able to say, so this is how much risk I'm exposed to. So is it still acceptable, or should we say the risk is no longer acceptable? And even if you look at scenario analysis as well, scenario analysis is very much linked to simulation. We are basically saying that you input data. Usually when you look at scenario analysis and simulation, you will see that it's very much linked to using a computer system where it generates different possible outcomes depending on the input that you put. Then you can say, based on the scenario analysis and simulation that I've used for these different scenarios that I'm playing around with as well, how much risk am I expecting generally to be exposed to as well? Then you can now determine your expected standard deviation, for example. Are we
Okay, now
yeah.
I totally understand.
So, models are basically used to make our decision making easier, so that our decision making becomes consistent as well. Any other questions?
Hi, Reynolds.
Yes.
Can you hear me? I just wanted to find a little bit of a distinction, right? In terms of risk financing, are we always going to be looking at univariate models where we're just looking at one thing, or maybe also see like multivariate instances where we're probably calculating multiple weights of standard deviation and variation in terms of measuring the risk tolerance and appetite?
We'll look at that in study unit 7. But remember what I told you, that study unit 7 is very much linked to study unit 11 as well. So if it's a multivariate, the maximum that you use is what you've covered in undergrad, where you're looking at, for example, if it's standard deviation, you're looking at the standard deviation of for example, 2 instruments or 2 securities. That's the maximum that we usually do. For example, if it's expected return or standard deviation. But remember, from a risk financing perspective, we don't go in too much detail when it comes to these elements as well. But usually you see that in study unit 11, that's when we now look at risk measurement, where we're basically saying that the models that are going to be using, where, for example, you're calculating maximum probable yearly loss as well, you'll see that we are not going to be going too much in depth when it comes to, in short, I'm basically saying we are not going to be going too much in depth when it comes to the statistical models that are going to be using.
Got you. Thank you.
All right. So you'll see that when we go through study unit 11, please take note of the information and instruction that I'm going to be giving you, because you see that study unit 11, there's a video that we took where we were going through, where we did go in depth when it comes to the statistical models that we need to understand, that are used in risk financing as well. But remember, it's fine. I'll cover them in more detail. I don't want to confuse you now because you haven't seen that information as well. But we'll cover it in more detail and give you a proper guideline when it comes to statistical models as well. Because usually the models that we usually use is calculation of the expected return and calculation of the standard deviation when it comes to risk. Then these two, we now use them for the models that are going to be looking at in study unit 11. The other statistical things that are going to be unit 7, don't worry much about them, but I'll give you a guideline when we get there.
All right. Thanks, Reno. So in summary, there's a correlation between risk financing and credit risk as well as market risk in terms of those statistical models.
Yes, because remember, all these are risk. These are basically risk. These are the risk financing is basically looking at from the finance perspective. But remember, credit risk is basically looking at it from a borrower, from a lender's perspective as well. For example, especially banks, and then market risk is also looking at the risk exposures in the market as well. But we'll look at it. There is some correlation between these as well, because they all contribute towards the overall risk of the firm, basically.
Thank you, sir.
All right. Are there any other questions? All right. We end here today. Please note that next week, Saturday, we are having a class. And next week, Saturday, we're going to be looking at study unit 1.6, and then we move on to study unit 2. And please note that during the course of the week, I'm also going to be sharing the database for the answers for quiz 1 as well. But have a look at quiz 1, because you will see that quiz number 1, it's mostly those housekeeping type of questions which you really need to know, instead of me just giving you that information, because it's things that you really need to know, not necessarily for exam purposes, but for you to know for the module as well. But I'll discuss that with you during the course of the week. And remember, if you have any questions regarding accessing the website, creating the user account, remember I said that from today, you have a 7-day period where you are going to be able to access the website so that you're able to familiarize and decide whether you want to register with us as well. So if you want to have any questions on how to register or how to create a user account on our website as well, so that you're able to link your modules as well, communicate with me on WhatsApp, then I can be able to link you. But I'll only do that after 5 today. All right, enjoy the rest. Yes, is there a question?
Yes, can you please just say the name of the article that we focused on today, like the name of the article?
In the articles that I'm going to send you, it's just unit 1.5. Article for unit 1.5. You will see that on the info on the Google Drive that it would take you to as well. The different study units are named unit 1.5, 1.6, 1.1, whatever. So today we looked at unit 1.5, so which means that the name of the article, don't worry about it. Just look for the article for unit 1.5.
Okay, thank you.
All right. But remember, just for information's sake, the article is risk management failures. What are they and when do they happen? That's the name of the article. Risk management failures, what are they and when do they happen? So it's the article for unit 1.5. All right, enjoy the rest of your weekend.
Thank you. Bye-bye. the risk management cluster.